music? China? What are they even saying? What is this Chinese rap music? Sounds like they're just saying ching chang chong.
My chance new girl watch made in China. We play ping pong ball made in China.
Hello and welcome to China Econ Talk. I'm your host Jordan Schneider here today with Logan Wright, Director and Head of China Markets Research at the Rhodium Group. He, alongside his colleague Dan Rosen, just released a book-length treatment entitled Credit and Credibility: Risks to China's Economic Resilience through CSIS for free. Logan, thanks so much for coming on the show.
Thanks, Jordan. Appreciate it.
So first off, why'd you decide to tackle this question?
Well, this is the culmination of a number of different strands of work we've been engaged in at the Rhodium Group for several years. And fundamentally, the story that was most interesting to us was that everyone's talked for years about why China might face a financial crisis. And the case there is, it's obvious. It is not necessarily a new story. Certainly, there are reasons to be more concerned about the development of the financial system over the last 5 to 6 years in particular, given the fact that it's roughly doubled in size since 2012. But if you will, the analytical discussion of whether China will have a financial crisis is pretty well-trodden ground. What's less studied in our view, and what was most interesting to us, was why has China avoided the problems of other emerging markets who have engaged in similar patterns of credit expansion over the past 30 to 50 years or so. And therefore, we wanted to do a really deep dive into the factors that have kind of been used most frequently to explain China's financial resilience. And what emerged from that, and what really prompted the study as it is presented, is that many of those explanations are increasingly unconvincing. And in reality, they kind of can all gravitate around three potential explanations, two economic and one essentially political in nature. But what we think was really unexamined was fundamentally, why is China's system behaving differently than other emerging markets?
For the first part of this interview, I want to walk through the first few chapters of your work, where you give a brief and rather compelling history of the Chinese financial system since 1990. So you write that in the unreformed system in the 90s, many issues came into play that are still rather dominant in today's financial system. You write that it was bank dominant, there was a strong moral hazard, there's favoritism towards SOEs, and it's generally anti-private credit. There's a slow development of corporate bonds, few institutional investors leading to casino-like equity markets, and finally, very little foreign participation in the Chinese financial markets. Do you want to pick one or two of those and maybe highlight them, the ones that you think have particular resonance from the 90s to today?
Sure. I mean, I think what's one of the most interesting dynamics within the Chinese financial system is that banks continue to have this strong preference for lending to state firms and a strong preference for lending on the basis of government guarantees and fixed assets as collateral for loans. And what that, in essence, does is it always puts private firms who don't have considerable fixed assets as collateral for borrowing at a disadvantage. And because of the net interest margins that have been essentially guaranteed throughout the Chinese system, it incentivizes volume-based lending, which always encourages more loans to state-owned enterprises. Meaning that it's far easier for a bank to make one loan for 1 billion yuan with a government guarantee rather than 1,000 loans for 1 million yuan on a transaction cost basis.
So the bankers are lazy.
It's not necessarily the bankers are lazy, but bankers are risk averse in a context in which you are essentially incentivized to take similar risks to others within the system. And if the financial system is focused on growth, which the financial system should grow consistent with a developing economy, it obviously makes sense to facilitate, if you're an individual financial institution, the fastest growth of assets possible with a relative minimum of risk. And in the Chinese political context, that has always meant lending to firms with government guarantees and fixed assets as collateral, which has tended to disincentivize private firms. To really incentivize lending to private firms, you need to not only lend on a different basis with some confidence in the financial information that's being provided, but you need a higher net interest margin to justify the additional risk. And this is often what occurs in the context of the Chinese system, where government guarantees throughout the system end up distorting risk premia and potential pricing of a number of different financial assets, because many assets are perceived as essentially guaranteed. So what's striking is that dynamic was obviously present throughout the 1990s, but it's still present today. And most banks in the post-financial crisis period ended up lending extensively to local government financing platforms and other firms with essentially implicit guarantees. And that's really what facilitated the very rapid growth of the financial system in the post-crisis period.
So let's talk about this first period from 2000 to 2008, pre-global financial crisis.
Well, pre-global financial crisis, you had very strong rates of nominal growth within the Chinese economy. So you had nominal GDP growth. I'm not don't have it off the top of my head, but it would have been averaging around 15% or higher throughout most of the decade from post WTO accession from 2001 to 2008. Really picking up in 2004 to 2007, very rapid rates of growth. And in that environment where nominal GDP growth is so strong, virtually anything you lend to will probably be profitable. And so it therefore creates incentives. Anything you invest in will also probably be profitable. So therefore it creates incentives for firms to access as much bank credit as possible. Obviously, in that environment, you also had a pretty strong pickup in inflation. So essentially, the PBOC moved to trying to use administrative controls over the quantity of credit to try to control some of those inflationary outbreaks that occurred during the previous decade. But the financial system in that period from 2001 to 2008 had just been restructured post the Asian financial crisis, part of the Central Economic Work Commission that Zhu Rongji had set up in order to restructure the banking system after the Asian financial crisis, with many of the economic players at that time, taking leading roles in the financial institutions at that time. Zhou Xiaochuan obviously came out of that, the PBOC governor from 2002 to 2017, obviously came out of that process and was one of the key reformist voices therein. But you didn't have a sustainability problem within the Chinese financial system from 2002 to 2007. You had an efficiency problem because they were still allocating too much credit to largely state-owned borrowers, and there was still a preferential act. It was still difficult for private sector firms to access credit precisely because you were needing to control the overall volumes. But you didn't really have a sustainability problem because credit growth was roughly in line with nominal GDP growth at that time. There had been some banking system restructurings and recapitalizations that took place in 2003 and 2005. And then you had the banks preparing to list on overseas exchanges in 2006 and 2007. And, that process essentially hit reset on a lot of the Asian financial crisis era lending. And then you had a period where those institutions could continue to grow their way out of whatever non-performing loan problem that was there, because from 2000 to 2008, you basically had about a 4 to 5 time expansion of the banking system, and so that allowed you to grow out of those problems.
Sure. One of the interesting points you make in this piece is that even though in this period the numbers seem so enormous, 4x, 5x growth in the financial system, these 15% growth rates, it's important to understand the base in which China was building off, which was incredibly artificially depressed coming out of the Mao era. Correct?
Well, right, especially in financial institutions. And this is a point we make in the book. China's compound rate of growth looks remarkable over any period of time, objectively, but it never had to be that high to catch up to the same level of economic development that we're seeing today if there hadn't simply been an artificial constraint on it from Maoist experiments throughout the 1950s, 60s, and 70s. If China had started at just a reasonable developing country rate of growth, you wouldn't have needed to see a reasonable developing country rate of per capita GDP. You wouldn't have needed to see a huge dramatic upswing in GDP growth over time. And in many ways, that concern, I think, animated Chinese leadership very early in the process of reform and opening in the 1980s and 1990s. There was always a concern that China had been behind and needed to catch up, and therefore often fast growth, even if it generated financial risks, was prioritized over more sustainable rates of growth. And that essential policy bias still does persist in certain ways within the Chinese system. The difference was in the 80s and 90s, those trade-offs were not that severe, precisely because there was a lot of catch-up growth to be done, not only in the economy, but in financial services as well. And every financial system reaches a point at which the benefits of deepening or expanding access to financial services in different forms to households and corporates, reaches a point of diminishing returns. And that's really the discussion. There was no real risk of them hitting that period of maximum financial deepening or a saturation point in financial deepening anywhere until in the post-crisis period, the post-financial crisis period.
Sure. The line that stuck out to me was you're saying that in the piece, if China was at Nicaragua level, so around $2,000 GDP per capita, it would have only needed to average about 3.5% GDP growth to get where it is today, starting in the 80s and 90s, which is really striking given that, to get a sense of how backward China really was at the time. So you did a perfect lead-in for me to talk through the financial crisis. So what happened, and how did the response from China differ from the way the U.S. did its stimulus package?
Well, exactly. China wasn't affected as directly via the global financial crisis, except primarily in terms of trade finance. So you had a situation where Chinese exports dropped precipitously, consistent with the slowdown in global growth, and all of a sudden dollar trade financing wasn't available. But in essence, in the post-crisis world, the rest of the world was looking for a very aggressive pattern of largely fiscally led stimulus to close the output gap and try to stabilize the global economy back to a more reasonable footing. China unveiled in November 2008 probably one of the more aggressive stimulus packages available, which was billed at the time as a 4 trillion yuan stimulus effort, and with the headline number, of course, attracting a lot of attention. In reality, it was much, much larger than that because of the form in which they launched this post-crisis stimulus. And that was because they used the banking system rather than the central government budget and official fiscal issuance in order to launch a credit expansion and what was largely an infrastructure-led expansion. Credit growth exploded in 2009 and 2010, and it was led by local governments.
So could you explain how, what Obama did of, just having the federal government directly spend versus the Chinese strategy of just cranking up credit and lending actually means the amount injected into the economy ends up being a lot bigger than what other governments around the world did?
Well, essentially what China had done was it released some of the constraints that they had placed on bank lending for local governments. And by releasing some of those constraints, the localities were incentivized to set up new companies, local government financing vehicles that all of a sudden had clean balance sheets, to inject those companies with forms of capital, which was typically in the form of land, and then to borrow aggressively from local banks on the basis of that land or the promise of government repayment for an infrastructure project as collateral. Banks and local governments didn't need very strong incentives to start this process because growth had been so strong in previous years. They already had very strong incentives to launch these types of projects. What was constraining them was central government control over issues such as land permissions, as well as the overall availability of credit. And after the financial crisis, those were out the window. If you look at a developed economy, for example, it was much more conventional offsetting the deleveraging that was going on in the household sector with a releveraging in the government sector, and trying to essentially provide some sort of government offset to what would otherwise have been a more dramatic contraction in household consumption and business investment by changing those incentives with some degree of government support. That played a role in the Chinese stimulus, but largely this was about unleashing local governments. And once unleashed, that really changed the balance of power in Chinese monetary policy and in the overall balance of economic policy, precisely because local governments essentially could hold the central government ransom, saying, well, we've already started all these projects. If you want us to stop, there'll be an immediate fiscal cost to stopping these half-built bridges, tunnels, other roads in their tracks. You'll have to pay for that right away, and you can't really afford to do so because those projects haven't been completed yet. Or you can just let us complete them. But in the end, allowing that completion requires additional credit. And with localities still having strong incentives to compete against each other to drive growth, that created almost an ongoing pipeline of local government infrastructure projects that was very difficult for the central government to ever slow down.
So I imagine, aside from these macro things, just coming down to the person level, like it seems like a lot of people were getting rich off these loans, and there's also a lot of personal incentives from personal wealth perspective, as well as a promotion up the CCP ladder perspective to keep this going from the not from the regulatory side, but from the local and provincial government perspective. Is that a fair characterization?
Well, I think what's fair to say is that there's any time there's an expansion of the money supply, and the Chinese money supply almost doubled between 2008 and 2011. Anytime there's an expansion of that size, you are literally doubling the amount of money in an economy. That is going to create all sorts of incentives for misallocation of credit, whether that's in the form of official misallocation for investment via banks, or more personal reallocation via corruption and other transaction-related costs that are obviously still an ongoing problem in China and elsewhere, where infrastructure-driven lending is such a dominant proportion of economic activity. So it's fair to say that there were strong political incentives at that time to make sure that the stabilization in the economy was entrenched, and then worry about the consequences later. And in reality, China didn't have to worry about the consequences of the post-crisis credit expansion until starting in 2011, when they started to see inflation pick up once again in the early part of the year.
Sure. So let's come to late 2011, early 2012, and walk us through the dilemma that the banks face with this inflation, with this dose of inflation.
Exactly. So this is a critical turning point for the direction of the Chinese financial system, in many ways for reasons that had very little to do with China itself. There were some external factors, particularly linked to the European debt crisis, that really played a role in changing the way that the Chinese banking system itself operated. And I know that's a very strange thing to say, but you have to put it in the context of how the banking system had been growing for years and years. In the past, you had very steady growth of deposits. You had very steady loans were essentially given to state-owned enterprises. So there wasn't a lot of shadow banking activity until 2011. Shadow banking was largely a way to circumvent credit restrictions imposed by central authorities. So in 2010 and 2011, you had the reimposition, because Chinese banks were essentially struggling with, the Chinese economy was struggling with inflation. You had the reimposition of de facto credit quotas, and you started to see credit growth overall. You had reserve requirement hikes for banks, basically locking up liquidity on the central bank's balance sheet. And you started to see credit overall start to slow. Well, banks still found credit profitable at that time. So one of the things they started doing is collaborating with third-party institutions like trust companies, like asset management companies. And what they would do is they would continue to make loans as before, but then after the loan was made, separate it and sell essentially, or warehouse the asset on a third-party institution's balance sheet. And by doing that, they would basically provide a fee to the third-party institution for doing so. And essentially, they would create a new asset, which is a claim on a third-party institution that would have much of the characteristics of a loan, but wouldn't necessarily count against your credit quota in 2011. Now, that was in 2010 and 2011. That was very common. And it was becoming increasingly common as a way to avoid credit quotas. But it wasn't really a core business of the banks. It was largely just a bit of regulatory arbitrage on the asset side, which was irritating the central bank because it was frustrating their ability to control credit. But inevitably, when monetary tightening continues for 2 or 3 quarters in China, this is a system that depends very heavily on short-term interest rates because many of the loans in the system are less than 1 year in duration. So as short-term interest rates started rising, all of a sudden there really was a contraction in credit demand in the economy. And in 2011, you saw that most distinctly in the property sector. When the property sector started losing its demand for credit, you really started to see a broad-based decline in the economy in China that was also coinciding with, as I mentioned before, the European debt crisis or the peak of the European debt crisis in late 2011. And that combination of factors started producing, for the first time, pretty substantial capital flows from China. European banks started pulling back from indirect loans, wholesale loans that they had made to mainland institutions. And as a result, China, for the first time, faced a situation where deposits onshore weren't growing very fast. They were starting to slow substantially. And so the basic funding base for the banking system had come under pressure for the first time. For years and years, with very steady inflows under the trade surplus and under investment surpluses, because the renminbi was appreciating, there were always reasons for speculative capital to flow into China. Deposits typically grew faster than loans. PBOC was trying to control loan growth, but always wanted to see deposit growth that was always had no problem really with deposit growth being strong. It was a question of how banks would be deploying those deposits for their own economic purposes. And now all of a sudden you had this pressure emerging on the deposit bases of the banks in late 2011, and deposit growth started weakening. That really changed the game for the way the Chinese banking system operated. And it also changed the situation vis-a-vis the renminbi, because for the first time, even though China was running a trade surplus, capital outflows were larger than that trade surplus, and we're starting to put pressure on the currency itself.
So it's an interesting theme, these two contravening forces. On the one hand, you write that authorities allowed unfettered financial innovation and regulatory arbitrage to thrive. But at the same time, you do have these regulators who just seem just like such sorry officials. They try their best, but the banks and the local governments can get around almost everything they throw at them. So this tension seems like a really interesting one that kind of plays out over the course of this whole story.
Yeah, I don't think the regulators are hapless in any respect. I think they are institutionally disempowered vis-a-vis local governments. Local governments outrank, and local government officials typically outrank Chinese regulators within the overall institutional structure. But more fundamentally, leadership would rather default to more local government excesses at the expense of regulatory overreach, so to speak. And this was linked to the broader political decision to make sure that the economy is stable first, and going all the way back to that post-1980s emphasis on faster growth, make sure that we can still maintain a rapid rate of growth. And if there are negative consequences of that, well, that's the regulator's job to make sure they don't get out of control, not to necessarily stop those negative consequences in their tracks or to intervene before they happen. I mean, PBOC and CBRC were concerned about the post-crisis credit expansion as early as May 2009. And that, obviously didn't have much of an impact on the way in which the credit expansion continued. But it's not fair to say, I think, that the regulators were just powerless or didn't really understand what was happening. In many ways, regulators were incentivized to keep growing the financial system at the same time.
Sure.
So you also had this competition among different regulatory bodies to grow assets internally. And you didn't really, until this year, have a lot of central oversight of the shadow banking system as a whole. I like to say that wealth management products, when they were created in China, were a regulatory orphan. No one really created them or said that wealth management products should exist. So therefore, they were no one's responsibility at any point. And when they took different forms, and when shadow banking took different forms, it was obviously there was not a very strong regulatory response.
So let's bring us back now to June 2013, the closest China's come to a true financial crisis. So what happened here, and what were the broader impacts of the way the government responded?
June 2013, is sort of the way I would say it's sort of the end of innocence in Chinese financial management. It's the end of innocence for the Chinese financial system. From June 2013 onward, basically, Chinese authorities had to be constantly aware of the potential for a crisis within their money markets and aware that they needed to engage in crisis management alongside regular monetary policy making. And what happened in June 2013, I think, is it's a great story to tell, because it's something that they've been trying to avoid ever since. And the consequences of avoiding another June 2013 type short end squeeze in interest rates has been to really expand the shadow banking system further, particularly in 2015 and 2016. And so in our view, many of the problems that emerged in the Chinese financial system, with the stock market bubble in 2015, with the currency devaluation in late 2015 as well, with the need for supply-side structural reform in 2016, and now the deleveraging effort, are very much a consequence of the realization that the June 2013 interbank market crisis was always a possibility. What happened basically was that Chinese banks were reliant upon wealth management products, meaning these short-term commercial paper type, deposit type structures that needed to be rolled over every 1 to 3 months for increasing marginal growth in the banking system as a whole. And the PBOC, CBRC top leadership was aware of this. They weren't necessarily happy about it. They saw this as a potential source of risk, and increasingly the money raised via wealth management products was being deployed into shadow assets. So more loans being made to non-bank financial institutions, more restructuring of loans into different forms that Beijing could not easily manage or regulate. That's not a stable financial system. So you'd seen, starting from this period in 2011 to all of a sudden June 2013, you had a system that was no longer funded just by deposits. It was funded increasingly at the margin by these commercial paper type instruments. It was no longer making loans just to state-owned enterprises. It was making loans to some local government entities in contravention of credit policy, to property developers, to anyone willing to offer higher interest rates, even if that activity was riskier, as well as engaging in some outright speculation in the money markets. And you had also seen suddenly changes in balance of payments flows. So you couldn't rely upon external sources to keep generating liquidity for the banking system. Sometimes capital outflows would dwarf current account inflows, and you'd see a drain in deposits from the system. And all that set up for what happened in June, because we were in the midst of what in financial markets we called the taper tantrum, where Bernanke had started to discuss the possibility of tapering support via the Federal Reserve's balance sheet. And that caused a pretty sharp sell-off in emerging markets and emerging market currencies, and started to create some pressure on the renminbi. That wasn't really what caused the June 2013 crisis in China, but it was certainly a factor that contributed to its severity. June is always a really difficult month for liquidity within the Chinese money markets, and has typically you do see short-term interest rates rise during that month. And the PBOC chose a relatively mundane event, which was a default on an interbank payment between two mid-sized commercial banks, in order to teach a lesson to the banking system for relying upon these shadow instruments. So usually what the PBOC would do, if they saw an interbank market default, short-term rates would rise, and this happened on June 6th. Short-term rates would rise, then the Open Market Operations Department would sort of survey demand for short-term liquidity, and that would be provided in order to prevent any significant defaults. But that after surveying for that demand the next day, the bank didn't provide any liquidity. And so then there was a holiday, the Dragon Boat holiday, which was 3 days. And when the PBOC came back from that holiday, they didn't say anything. And all of a sudden, money markets had to grapple with the fact that the PBOC wouldn't necessarily be there to support money market conditions. After the next week came about, the PBOC actually held a meeting with commercial banks that was documented in a circular that they released the week afterwards, in which apparently the message was, help will not be forthcoming. You need to sort out your asset and liability mismatches. And basically right after that took place, all hell broke loose in the money markets, because suddenly banks had to hedge and reprice against an additional risk, which was the risk that the PBOC wouldn't be there to support basic functioning in the market. And it wasn't that anyone was concerned that, you couldn't deal with the agricultural bank, you couldn't deal with ICBC, they wouldn't be around the next day, the way that counterparty solvency risk really ricocheted around the global financial crisis. It was more about counterparty liquidity risk. In other words, I don't want to do business with you because I'm not sure the PBOC is going to provide you with enough support. And so therefore we might do business next month, but I'm waiting for their signal. And so
the counterparty risk, again, this is key, became a question of to what extent does the PBOC trust, believe that you're important, as opposed to more fundamental questions about your balance sheet and whatnot.
Exactly. And so all of a sudden you had short-term money market rates rising. And when that happened, it caused the structure of funding that had been created under wealth management products to all of a sudden implode. Because if you were holding a wealth management product that was going to return over 3 months, say 5-6%, and you had the ability to redeem it, interbank market rates were suddenly 8-10%. You could just redeem the product and start to lend out that money on your own. So redemptions of these products started surging. And when that happened, all of a sudden banks had to borrow more money to meet the redemptions. So that process continued, and pretty soon there were absolutely no lenders left in the money markets. And that happened in just about 6 days from the initial PBOC signal to June 20th, when short-term money market rates in China basically rose to 20-30%, meaning that there was basically no liquidity left in the system. And when that took place, all of a sudden, all sorts of asset markets started selling off. First, money market funds faced big redemptions. The equity market sold off about 10% in just a day and a half. And at that point, the PBOC called time on their experiment around June 25th, I believe, and started injecting liquidity once again and reinforcing that they would always be there to provide financial stability over time.
Before we go to the consequences, I'm curious if you have any anecdotes from that week in June. What was the emotion of the folks you were talking to? Were you on the beach? What was your personal experience of that?
The week and the month is indelibly etched in my memory because I was married at the first on June 1st in 2013.
Oh, Jesus.
And so the first interbank market default, we weren't on honeymoon or anything, but the first interbank market default occurred basically the end of that week after we were married. And I told my wife, I said, all right, of all the things that could have gone wrong during our time off, this is the one I'm sort of most prepared for. So it's okay. But it was still an all hands on deck kind of moment, trying to assess what banks were doing and how they were managing these pressures. I don't think that the widespread stress really hit it was very apparent to the money markets, and stress in financial systems always emerges in the money markets first, but it was very apparent in the money markets earlier in that month. I don't think it really became, it in essence escalated in terms of a story from first, this is a very strange thing happening in Chinese money markets. So it's sort of a page 3 story in the Asia edition of a major newspaper like the Wall Street Journal or the FT, to suddenly becoming, this is a major event in Chinese financial markets. So it was a dominant story or regionally, so to speak. And then all of a sudden it became, this is China's Lehman moment in the eyes of some reporters. And that's, there's ways to quibble with that comparison, but the level of stress was severe. And so it escalated very quickly over the course of that month, and people started to take the threat a lot more seriously, and the PBOC had to as well.
So you write that in the PBOC's response, the moral hazard, which we talked about earlier in this podcast, was entrenched as opposed to broken. So can you unpack that for a second?
Basically, the PBOC was trying to send a signal that you were on your own. You needed to manage these asset liability mismatches on your own if you're a banking system, and we will not come to your aid. The system almost came to a screeching halt when they did that. And therefore, in the future, if you're a bank and you're looking at the rise in short-term money market rates, are you worried? You're not that worried. Precisely because you know that the last time this happened, the PBOC basically had to back down, and they couldn't really enforce any discipline. So in essence, it highlighted the difficulties of using monetary policy tools to really slow the shadow banking system. And sort of bringing us up to date, it highlighted the need under the current deleveraging campaign to start using a more enhanced regulatory apparatus, which for years under the disparate and competing regulatory institutions, the CBRC, the CIRC, they're actively competing to sort of grow financial asset bases. That never existed. So what happened after June 2013 is there was another similar spike that emerged in December 2013. And then there was another one in January 2014. And the PBOC didn't want to be very public about injecting liquidity to calm those down, but the markets perceived the signal that they would basically have to back down and would have to provide liquidity in times of stress. And after that, you saw, as a result, a lot more stability in short-term money market rates. For years and years, the PBOC had allowed money market rates to move in line with demand for credit, and it provided them with reasonable visibility into the overall demand for credit in the system. But now that volatility, that rise, that signal that they were receiving was suddenly a potential source of systemic risk. So you had to control it. And when they started controlling it, that had other consequences, which meant that short-term money market rates were all of a sudden very stable, which means you could start borrowing in the repo market. And from 2013 to 2016, daily turnover in China's repo market expanded basically about 500%.
And I think that brings us up to today. So at the beginning of the podcast, you were talking about the sort of explanation of over these past 20 years, even given the extraordinary growth in China's financial system and credit markets, there hasn't been a crisis. And you talk about 3 different potential rationales for why that may be the case. So let's walk through the first one. One of the things you often hear, particularly from Chinese policymakers, is that the high savings rate will act as a buffer in terms of any credit crunch. So what is this? Unpack this argument and explain why it doesn't carry too much water in your opinion.
Sure. It's not that it doesn't carry water. It's just that it's often unveiled in a very sort of very cursory manner to assume that therefore China has ammunition to potentially offset any short-term pressures that emerge within the financial system. And essentially, if you have a high savings rate, that means that that's a high rate of foregone consumption, which means that and China's savings rate is around 46% of GDP, extremely high by global standards. The issue and therefore you would assume that government could effectively if there was ever any shortfall in liquidity or in financial resources available within the domestic system, that the government could simply reallocate resources in order to meet that, because you were still saving there was still a lot of foregone consumption and savings building within the financial system. The problem with that, in our view, is that it's not exactly easy, given where savings in China is concentrated, to do so, and the reforms that you would need to unlock those savings are really longer term phenomena. They're mainly changes in tax policy. Savings in China is concentrated, in essence, among state-owned enterprises, where, of course, state-owned enterprises do have resources the government can compel, but that's been an ongoing debate for 30 years about exactly how to force state-owned enterprises to contribute more to state purposes, and to increase dividends from those enterprises, to increase competition among those institutions as well. It's concentrated among private sector corporates who are essentially cut off from the financial system. And therefore, it's hard to really see how they become integrated into the financial system so that you can reallocate resources. And then savings is also concentrated at the household level among wealthier households. So, which is a common issue across many different economies. So it's not that you don't have a high national savings rate, but there's no easy way to, in the event of short-term liquidity stress, to unlock those savings to really offset any shortfall in domestic liabilities. And that's, in essence, what we see as one of the issues involved. The other is that China's actively trying to reduce their savings rate over time. And the high rate of savings is a problem for economic development. You need to be moving to a more consumption-driven outlook and a more consumption-driven growth model. And therefore, savings is going to need to come, the savings rate is going to need to come down over time. And so it's not necessarily, a consistent argument in our view to say that, well, China has this great buffer against financial crisis that they're actively trying to reduce over time. That's certainly the truth, but it's more accurate to say that, the savings rate, in essence, reflects some of the distortions within the Chinese financial system. It is not easy to reallocate savings within the Chinese system or to change that savings rate very quickly over time.
So turning now to the second argument that you don't quite think would be useful in a financial crisis, the line that, Chinese debt is domestically held, it's denominated in RMB, so unlike the Asian financial crisis or other financial crises around the world where the domestic government couldn't just print money to get out of it, we have this ultimate lever where we'll be able to handle our own debt.
Right. And of course, there's truth to this argument that most Chinese debt is domestically held. There's no external creditors involved in most of the post-crisis credit expansion. I mean, China does have some external debt problems, but nothing that would be considered a real systemic risk that couldn't be offset with sales of foreign exchange reserves, for example. And nor would probably you see considerable pressure emerging all at the same time. But the bigger issue with the domestic debt issue is that it's contrary to financial reform. So, in the growth of China's domestic debt is not immune from default pressures. It just means it introduces new pressures domestically to manage those risks, and you essentially have to force losses on one institution or another within the domestic economy, which is frankly a pretty difficult political choice. China's dealing with this right now in terms of deciding how to allow local governments to refinance or restructure some of their debt that they have incurred, especially the implicit debt levels. So there's a question of most of the structure of China's debt is basically held in corporate forms, which means it's at higher interest rates, very expensive to service. Why do I say corporate forms? Because a lot of these are essentially loans to local government financing vehicles, which can be state-owned corporates at the local level, or in de facto loans to state-owned enterprises. The average interest rate on a lot of those loans throughout the Chinese system is a bit north of 6%, when the system is 3 times GDP, that means you're paying around 15% of GDP in interest every year to the banking system. Even though that is a domestic problem, it still requires a good deal of political management to offset it, and there's still considerable risks of default within the problems of within a domestic debt-dominated landscape. External creditors in many ways might have introduced a little more caution and restraint into the Chinese financial system than a purely domestic creditor base has done so far. And so, that is one issue, that when the debt problem is large enough and expensive enough, the fact that the debt is domestically held doesn't necessarily reduce the risk. And the second point is that most people say, well, China can just print money. The issue is, of course, that process is completely contrary to the nature of financial reform. Yes, you can take action on any individual day to prevent probably a crisis from developing that day. But in doing so, you don't necessarily reduce the risk of a problem in the medium term. Often when you discuss this question with other analysts, you get into this question of timeframes. Nothing in the long term with China looks very sustainable because you've seen very rapid rates of credit growth relative to GDP, well above any historical precedents. As we mentioned in the book, you're talking about, in the post-crisis expansion, $29 trillion in bank asset growth relative to just over $7 trillion in nominal GDP growth. So none of that looks sustainable over the long term. But in the short term, you also can't necessarily see a pressure point that China doesn't have state capacity to manage. The interesting thing in the medium term, when you think about this, is that China doesn't necessarily want to identify and solve all of the problems that are emerging within the financial system. To reform the system and to make it more sustainable over the medium term, you have to allow a certain degree of risk to materialize. You need to be better pricing credit risk. You need defaults to occur. And this is where we get to what we think are the most plausible scenarios for real financial stress in the Chinese system.
We'll get there.
It's when all of a sudden those conditions change. Precisely like what happened in the interbank market crisis in 2013, all of a sudden market participants had to reevaluate when the Chinese government would intervene and print money to resolve certain problems. So far, that has been a very low threshold of any immediate financial stress would cause a government response. That cannot be the de facto response mechanism over time. And this is sort of what we discuss in the study. Because of the increasing complexity of the financial system, the government is being forced to sort of extend that government credibility into increasingly peripheral and risky asset markets. And so identifying, just in response to the overall problem of, well, why can't they just print money? Identifying instances of financial stress and responding to them is not the primary challenge. You can certainly identify where stress pops up. You can certainly respond. But reforming the system over time requires identifying those instances of financial stress and, in certain conditions, not responding. In certain conditions, allowing that risk to be priced. And if you don't do that, if you just identify every single threat and respond to it with additional expansion of the central bank's balance sheet or additional money printing, you'll generate other risks in the system. I mean, notably pressure on the exchange rate, which we can discuss. But the 2013 interbank market crisis is really, I think, a byproduct of this, because you were responding to one source of pressure within the system and ended up creating a much larger shadow banking system in response to your attempt to control the funding growth of a much smaller one.
Yeah, it seems another theme here we have is these half measures end up being counterproductive in the long run. So the one pillar which all of this rests on essentially is the PBOC's credibility and the market's belief that at the end of the day, the government will not let terrible things happen to the financial system and the Chinese economy as a whole. So why do you think this is the clearest explanation, and what are the implications of that trust in the government being what's holding up the whole system here?
Sure. I mean, I think that when you break it down, none of the other macroeconomic or political arguments really start to explain how this system could have kept growing for so long. The joke I always used to make was, moral hazard isn't a problem, it's a strategy. This is exactly how the system has grown so rapidly for so long, because as long as there was an expectation that some government entity somewhere was on the hook for this risk, you didn't have to worry about pricing that risk yourself if you were a financial institution. And therefore, you were happy to keep extending credit on the basis of an expectation that if there were any trouble in financial markets, the government would respond. I think the post-June 2013 interbank market crisis period is a prime example. Short-term money market rates were extremely high, 8 to 10%. Wealth management products to get money back into the banks were being offered similarly at about 8 to 10%. And many, highly educated, people I know pretty well, Chinese analysts, economists, took substantial portions of their savings and placed them in Chinese wealth management products at 8 to 10%, a level that would indicate a high degree of stress in any other developed financial system. And why did they do so? Because they said, obviously, the government's going to have to support this system. Now, at some point, however, and I think you're reaching that level right now if you look at what happened with the peer-to-peer protests in Beijing on August 6th of this year, when all of a sudden that government commitment to shore up the banking system looks like it's supposed to be the same as a government commitment to shore up an essentially unstable peer-to-peer lender. And those are not the same degrees of government commitment. And when an investor thinks that ultimately they will be made whole, or that if they protest loudly enough or demand compensation loudly enough, they might be made whole, that's indicative of ultimately the flight to risk type mentality that has really engendered rapid growth within the Chinese financial system. And so what's interesting to us and why we think, what about credibility that's so important is that it prevents asset sell-offs and financial crises before they happen. You don't necessarily have to take steps to de-risk yourself. You can just wait for government intervention and responses. And we've seen this take place. One of the examples we discuss in the report is the Sealand Securities scandal involving entrusted bond contracts in December 2016, which was a very peripheral institution but having an outsized impact on the market, precisely because it was seen as potentially questioning an entire asset class, and therefore you had a sudden repricing of risk, throughout the financial system.
There's an interesting wrinkle in Chinese society, right, where the social safety net is incredibly low. So if you get sick or if you get unemployed, there's no real expectation in society that the government should be there to help you out. But if you're a middle-class Chinese or upper-class Chinese and you own a financial product that blows up, it sure as hell is the government's fault, and they sure as hell should be there to bail you out, right?
Well, I think that's a widespread perception. And I think there's a perception that's often made that anything extended through the financial system has government support, and it only could have existed with government backing. And so therefore, what you saw with the peer-to-peer protests is no real substantive response yet anyway, but nonetheless a very insistent demand from investors who had lost substantial savings, relatively wealthy investors, from an insistent demand that they at least receive some compensation for their losses in what were very risky investments. There was never any government guarantee on these products. There was never any explicit or implicit commitment from local or central government authorities that there would be any restitution in the event of loss. But nonetheless, people showed up based on that expectation. And why did they do that? Because Beijing has a very strong track record of acting in this way. And so that was one of the factors that led us to start to explore the notion of credibility as this source of support within the financial system. And what's most interesting now, as the financial system has become riskier and increasingly dependent upon both unstable liabilities and informal credit, that credibility is being forced to be extended further and further into the peripheral reaches of the financial system, where Beijing doesn't really have a strong incentive to provide support. And as that credibility becomes stretched thin, we think that more normal patterns of risk aversion and risk pricing, as Beijing will essentially step away from support of all of these assets at some point. We think more normal risk pricing is going to start becoming far more common in Chinese financial markets.
Could you talk a little bit about how you think the political bargain is changing and the implications for the financial system there?
Sure. And this is a central point in terms of the importance of credibility. In the past, the political bargain between Chinese borrowers and between Chinese depositors, households, and corporates, and those that place their savings within the financial system, they were in essence being promised faster economic growth, rising standards of living, and it was largely through employment and wage-based growth. Increasingly, most of the growth in Chinese household net worth has been in the form of asset prices, primarily property, but also in the form of financial market assets. And so all of a sudden, your standard of living, your potential gains from participating within the Chinese financial system is increasingly dependent upon a financial system that is taking a lot more risk. And so that's how the political bargain has essentially changed. Beijing is being forced to essentially defend portions of the financial system that it wouldn't have otherwise because of its penchant for essentially political stability. And you can view it as, up until this point, a preference for the growth of financial risk relative to a preference for the growth of potential political risk. And I think that's really what's changing at this point, especially under the deleveraging campaign, where the financial risks as they've accumulated have finally been deemed to be significant enough
of a political risk,
and potentially becoming a political risk on their own. Exactly.
So there's a tweet that I saw the other day responding to Donald Trump saying that he had a good conversation with Xi Jinping on trade, and he's looking forward to the G20 meeting in Argentina. And I think Qizhi Zhang said that he was admiring this magical tweet and that it is pumping up the yuan and Chinese stocks more effectively than the PBOC and all the official Chinese comments. So my question for you is whether or not Donald Trump has more credibility than Xi Jinping when it comes to the Chinese economy.
I do not think so. And obviously, there's numerous factors that explain what's happening in currency markets at any point, but a lot of the market reaction that occurred there, in our view, was largely just because of the need to reprice many emerging market assets in the face of a possible ongoing negotiation that might have the effect of offsetting some of the tariff implementation or escalation further on. Often you have markets when they're positioned very heavily in one direction, when all of a sudden you need to consider a different possibility, the repricing occurs very quickly. Nonetheless, that's also occurred very quickly, and we're kind of moving back in towards a depreciating renminbi, largely because you still have very divergent monetary policy conditions between China and the United States. And this is what we address in the book. Over time, given the size of this Chinese debt burden, China is going to need lower interest rates in aggregate. It'll also need better pricing of interest rates among some of the riskier portions of the financial system. But if you need lower interest rates in aggregate, and you probably need to keep responding to instances of financial stress domestically, that's probably going to point to a weaker exchange rate over time. And that's clearly in the report in terms of the logic therein. But in terms of credibility, I think it has a lot more to do with the track record of how Beijing will be responding to financial stress. Especially, doesn't have much to do with the renminbi itself.
Do you want to conclude with how this falls apart and what the path forward entails?
Sure. I don't necessarily think it has to fall apart per se. Our point would be that there are rising episodes of stress within the Chinese financial system that you can date, as I mentioned, largely from the June 2013 interbank market crisis. And Beijing has responded to those instances of stress very aggressively and has built up this track record of credibility in such a response. What's most interesting to us is what happens when that credibility changes. And essentially, that commitment to near-term financial stability is at odds with the commitment to long-term financial reform. And it's not that financial reform will necessarily go forward or that Beijing wouldn't prioritize stability over reform. We've seen that time and again. The issue is that you're not going to be able to grow the financial system sustainably at its previous pace. So you can't continue business as usual policy precisely because the financial system is already almost half of global GDP in assets. There are real limits to its ability to keep being funded at the current level, or particularly at the current exchange rate over time. So what's most interesting to us is that as these threats to financial stability start to materialize, Beijing is going to have incentives to change their own reaction function and to try to make it more sustainable over time. And it's in that interaction where the medium-term environment has changed, where all of a sudden you need to reprice risks within the financial system. You're not sure if peer-to-peer products are going to be supported. You're not sure if corporate bond defaults are going to be large enough that you need to reprice different assets. You're not sure if local governments will continue to receive support or to support their financing vehicles or their bonds, that assets will need to be repriced in China, and that will create additional risk. So that's where I think that we're going in the next few years, with more of these risks starting to materialize within the Chinese financial system. It's very hard to say exactly which one, as we mentioned in the report. But as the system has increased in complexity and you're now starting to slow credit growth very aggressively under the deleveraging campaign, it seems rather inevitable that some financial stress will emerge somewhere. And we're already seeing some of that this year with the pressures on corporate bond defaults and local government financing vehicle, the risk of local government financing vehicle defaults in particular. So I think that's what we're watching very carefully going forward. It also, as we discussed in the report, has implications for how we should view Chinese financial system. None of these characteristics that have promoted stability are really intrinsic to China's political system itself or to the China model as we kind of understand it. This is merely a byproduct of a, very long-standing pattern of intervention and a stated preference for political stability. And that's a very different conclusion than much of the commentary that you see attached to the potential resilience of the Chinese financial system over time, or this belief that China is somehow, different or exceptional. Our view fundamentally is that there's very few ways to avoid some of the pressures that are building up anytime you have a credit expansion this large. And what was most interesting to us is why China has avoided this for so long, but also why that condition, along with the political bargain at the heart of the Chinese financial system, does seem to be changing at present.
Logan, thanks so much for coming on China Econ Talk.
Thanks, Jordan. Much appreciated.
China Econ Talk is edited by Jason McRonald and Kaiser Guo and is a proud member of the Sinica Network from SUP China. For other great shows on China, check out the Caixin Sinica Business Brief, the Pan Daily Tech Buzz China, the New Voices Podcast, and of course, the Sinica Podcast, now in its 9th year. Until next week.